It seems that I say this about nearly every financial planning topic and account type, but I am genuinely excited to share education about Roth IRAs and tax-free accounts. To prepare for this lesson, I looked at Roth IRA statements across 12 custodians, including the most popular Fidelity, Vanguard, and Schwab. We are going to review the Roth IRA's unique contribution, investment, and distribution rules as we run through an example statement together. And if you have a Roth IRA, go ahead and download your most recent statement to follow along. I'm sure you're starting to see the pattern. You'll find the owner's name, address, account number, and type. And of course, Roth IRAs will always be individually titled since they are individual retirement arrangements, which is actually what IRA stands for. The account summary includes the statement period and the vertical formula. In this account, no contributions, transfers, withdrawals, or distributions were made over the period, and the account value increased by about 4% due to market performance and dividend and interest income distributions from the funds. Although employee contributions to workplace retirement accounts have a December 31st deadline, contributions to traditional and Roth IRAs can be made up to the tax year's April tax filing deadline, meaning you have 15 and a half months to contribute each year to an IRA. Health Savings Account HSA contributions follow the same deadline, but IRA contributions require earned income as a household. You will learn more about HSAs in its own lesson. Moving down to the current asset allocation, this statement shows 88% in stocks, 5% in bonds, and 7% in cash, more aggressively invested than the other statements we've reviewed so far. As a reminder, understanding asset allocation as a basic split of U.S. equity, non-U.S. equity, fixed income, and cash is all that's necessary. This simplicity is similar to how you might break up your intentional budgeting categories into save, invest, give, and spend. Next are the detailed holdings, shown as investment names, tickers, number of shares, price per share, and current market value. For greater clarity, we will analyze the investments individually and collaboratively as part of the tax-free asset location using our spreadsheet. And lastly, the statement includes the direct contributions made to the Roth IRA. As I mentioned, since you can contribute to an IRA in overlapping calendar years, it may show both years like this. Susan made a $6,000 contribution in 2022, but not in 2023, at least not yet based on this statement period. She would have until the middle of April 2024 to make that contribution. And if she were age 50 plus, she could also make an additional catch-up contribution, assuming they had enough earned income as a household. Although you may already understand the Roth IRA basics, here's a breakdown of additional details and common misconceptions. To start off, there are actually 4 ways to fund a Roth IRA. First are direct cash contributions, like Susan made, limited to the lesser of the annual limit or earned income as a household. So, most retirees cannot make direct IRA contributions unless they're married to a spouse with earned income to cover them. Eligibility to directly contribute to a Roth IRA is subject to income thresholds and limits based on tax filing status, as I've linked below the video. The second way is to implement taxable Roth conversions, which is moving pre-tax funds from a traditional retirement account, such as a traditional IRA, into the Roth IRA, with the converted amount included in taxable income in the calendar year it was converted. Unlike direct contributions, there are no limits or household income requirements for implementing Roth conversions. Taxable Roth conversions are often appropriate during years of lower taxable income, commonly in retirement between the termination of employment and when Social Security benefits, other pensions, Medicare coverage, and required minimum distributions, RMDs, begin. During the traditional versus Roth contributions lesson, you'll learn more about how pre-tax contributions and Roth conversions may complement each other to reduce your lifetime tax liability. When implementing taxable Roth conversions, it is often appropriate to cover its income tax liability from other savings or income rather than withholding from the conversion itself. That way, you keep more money in the Roth IRA to grow tax-free. And you definitely want to avoid withholding taxes from a Roth conversion if you're younger than 59 and a half, since the tax withholding itself would be subject to both income tax and a 10% additional tax, commonly called a penalty. Since direct Roth contributions have income thresholds, the third way to get money into a Roth IRA is to initiate a non-taxable backdoor Roth conversion, which is moving after-tax funds, called cost basis, from a traditional retirement account to a Roth IRA without tax consequences. When you implement a backdoor Roth conversion from a traditional IRA, you'd want to ensure that no pre-tax IRA balances exist by December 31st of the conversion year. Otherwise, the conversion may be partially taxable, since the IRS views all IRA balances as one big pot of coffee, with the coffee, the pre-tax deductible contributions and earnings, and the cream, the after-tax non-deductible contributions, all mixed together. You can only implement a completely non-taxable backdoor Roth conversion if you separate the cream from the coffee, splitting up the pre-tax and after-tax portions. You can do this by moving all of your pre-tax IRA balances, including simple and SEP IRAs, into a non-IRA retirement account, such as a 401k or 403b, by the end of the Roth conversion year. Since this may be new information for you, here's the order of operations for implementing a backdoor Roth conversion. The first step is rolling all pre-tax IRA balances into a non-IRA retirement plan, such as a traditional 401k or 403b. After that, you make a non-deductible contribution to a traditional IRA. At this point, there should not be any earnings within the account, just the after-tax funds, also called cost basis. The next step would be immediately converting the traditional IRA funds to a Roth IRA. This will leave a $0 balance in the traditional IRA. And the final step is reporting the non-deductible traditional IRA contribution and the backdoor Roth conversion on Form 8606, which is filed with the federal tax return. You'll see this form during the tax return lesson. If you have significant pre-tax IRA balances and cannot roll those funds into another retirement plan, using the backdoor Roth IRA may not be worth it for you. And the fourth and final way to get money into a Roth IRA is by transferring after-tax cost basis and Roth balances from other retirement accounts, such as a Roth 401k or a Roth 403b, into a Roth IRA without tax consequences by initiating a direct rollover. For example, if you're moving money out of a Roth 401k, you need to ensure that all pre-tax balances, including employer contributions and earnings, are transferred to a traditional IRA, with only the after-tax cost basis and Roth balances moving to the Roth IRA. Otherwise, you may accidentally cause a tax burden. If you work with a financial planner or tax professional, ask them to help you measure twice throughout the process to ensure you don't accidentally pay tax twice on the same money. Now that you know the 4 ways to get money into a Roth IRA, let's review how money comes out. Even experienced financial advisors and respected media sources confuse the Roth IRA distribution rules. To determine if a Roth IRA distribution is taxable and/or subject to a 10% additional tax, aka penalty, we'll have to separate 3 buckets in our mind. The first bucket, meaning it's withdrawn first, contains direct Roth contributions, tax-free rollovers, and non-taxable conversion amounts. These funds can be withdrawn at any age for any reason, tax and penalty-free. Next to be withdrawn, the second bucket contains taxable Roth conversions. Each year's taxable Roth conversion amount is subject to a 5-year holding period or until age 59 and a half, whichever is earlier. If you withdraw a converted portion before age 59 and a half and without meeting that 5-year clock, it may be subject to a 10% early withdrawal penalty, but it will not be included in taxable income since you already paid taxes on that amount when you converted it. And finally, after the direct contributions have been withdrawn and also the taxable Roth conversions, the third bucket is Roth IRA earnings. And this is where people, even the professionals, get the rules mixed up. Earnings are the accumulated growth above and after your direct contributions, non-taxable backdoor conversions, and taxable conversions within the Roth IRA. Those earnings are also subject to a 5-year rule, but it's a different 5-year rule than with the taxable Roth conversions in the second bucket. The 5-year rule for earnings is based on when your very first Roth IRA was funded. If you forget everything else, here's an easy way to think about it. If someone is over age 59 and a half, and it's been over 5 tax years since they funded their first Roth IRA, all distributions, including earnings, are completely tax and penalty free. If they are over age 59 and a half, but their first Roth IRA is less than 5 tax years old, the distribution of earnings will be included in taxable income, but without a 10% penalty. And lastly, if under age 59 and a half, the distribution of earnings is subject to income tax and a 10% penalty. There are a handful of ways to avoid the 10% early withdrawal penalty when distributing earnings before age 59 and a half, and we'll cover those during the early retirement distribution strategy lesson. With all of this said, These rules probably won't come into play for most people. Due to the account's favorable tax-free growth potential, Roth IRA funds are often the last money people distribute during their life, usually far beyond age 59 and a half. Now that we've poked that hornet's nest, let's move to the tax-free account spreadsheet to finish our investment account analysis. Just like the pre-tax account spreadsheet, we have the investment funds, their tickers, asset categories, expenses, fees, and the accounts in which they are held. The investment's cost basis, unrealized capital gain and loss, and tax impact columns do not apply to tax-free retirement accounts. Remember that qualified retirement accounts can be rebalanced without tax consequences. You may notice I also include health savings accounts, HSAs, on this spreadsheet. That's because they can also be invested for tax-free growth. In this complete example, I have highlighted the higher expense ratios, the significant fixed income position within Steve's Roth 401k, since they don't expect to spend it for at least 10 years, and the cash held within Susan's HSA and Roth IRA, which also happen to be misaligned with their savings objectives. In green, I've highlighted their low investment expenses as both a percentage and a dollar amount, and also their total tax-free balance, which will provide tax-optimized retirement distribution, medical reimbursement, and primarily tax-free inheritance to their beneficiaries. After this lesson, all of your investment accounts will be accounted for, included on the taxable, pre-tax, and tax-free spreadsheet tabs. You can now view your accounts on 3 levels: first, as a total portfolio; second, per asset location; and third, on the individual investment level. I hope this process has helped you gain clarity over where your money is and how it's currently invested. And moving forward, you'll also gain the confidence to make any changes in alignment with your own desired objectives.